October 1973. Across America, people are waiting in line. Not for concerts, not for phones, not for anything they want. They are waiting for gasoline. Lines snake around city blocks, an hour, 2 hours, sometimes an entire afternoon, just to fill a tank. Tempers crack, fistfights break out at pumps. The evening news shows images that look less like the most powerful nation on earth and more like a civilization coming apart at the seams. Gas prices have quadrupled, inflation is running hot, the stock market has lost nearly half its value. For the first time since the Great Depression, ordinary Americans are asking themselves a question that had seemed unthinkable just years before. Will my children live better than I did? History remembers this as the Great American Humiliation, the oil shock, the moment the Arab world brought the United States to its knees. But that is not what actually happened. What actually happened has been buried in the careful language of diplomatic cables, hidden inside the deliberate obscurity of financial mechanisms, and kept from public discussion for 50 years. The truth is this. Within 2 years of those gas lines, the United States would engineer a secret deal so consequential, so architecturally brilliant, that it would transform Middle Eastern oil into the very foundation of Wall Street's global dominance for the next half-century. The crisis didn't defeat America. It gave America everything. This is the story of how. To understand what came next, we need to go back 2 years earlier, to a sweltering August evening in 1971. President Richard Nixon appears on television across America. He is calm, measured. He speaks with the practiced reassurance of a man announcing something catastrophic in the gentlest possible terms. He is closing the gold window. The Bretton Woods system, the monetary framework that had governed the entire global economy since the end of World War II, is finished. Effective immediately, the US dollar is no longer backed by gold. It is no longer exchangeable for a fixed quantity of anything real. It is, for the first time in decades, simply paper. And the world panics. Central bankers in London, Tokyo, Frankfurt, and Paris scramble. Finance ministers convene emergency meetings. The question that haunts every boardroom and every Treasury department from Hong Kong to Hamburg is the same. If the dollar isn't backed by gold anymore, what exactly is it backed by? Nobody has an answer. The carefully constructed post-war economic order is dissolving in real time. The dollar's legitimacy, the bedrock of global trade, the reserve currency of the world, is suddenly a question mark. And then, 2 years later, war. October 6, 1973, Yom Kippur, the holiest day in the Jewish calendar. Egypt and Syria launch a coordinated surprise attack on Israel. The United States backs Israel immediately with weapons, intelligence, and political cover. And the Arab oil-producing nations respond with the only weapon they have. They turn off the tap. The embargo is total. Oil shipments to the United States and its allies halt. The impact is not gradual. It is instantaneous and savage. Oil prices quadruple in months. An American economy built entirely on cheap energy goes into cardiac arrest. The images of those gas lines become the symbol of American decline, the mighty republic, humbled by desert nations it had spent decades ignoring. But in the corridors of power in Washington, in the Treasury Department, in the West Wing, in the think tanks and war rooms where the real decisions are made, a small group of men are looking at the same crisis and seeing something entirely different. Not disaster, opportunity. His name is William Simon, Nixon's Secretary of the Treasury, a former Wall Street bond trader with a mind like a scalpel and an appetite for power to match. Alongside him, David Mulford, a young Treasury official who would spend the next 3 decades quietly reshaping the architecture of global finance. These men look at the Arab oil embargo and see the pieces of something extraordinary lying in plain sight, waiting to be assembled. The Saudis are suddenly drowning in money, billions of dollars every month, more petrodollars than their economy could possibly absorb, flooding in with every barrel pumped. They need somewhere to put it. They need security. They need a protector. The United States, meanwhile, needs a new foundation for the dollar, something to replace the gold that Nixon just abandoned, something that would create permanent, structural global demand for American currency. The pieces fit. In July 1974, less than a year after the embargo began, William Simon boards a plane to Saudi Arabia. The trip is kept as quiet as a Treasury Secretary's travel can be. The American president is weeks away from resigning in disgrace over Watergate. The economy is in ruins. From the outside, America appears to have no leverage whatsoever. Simon knows better. He arrives in Riyadh and presents a proposal that is, in its elegance, almost breathtaking. Part 1. Saudi Arabia will price all of its oil exports exclusively in US dollars. Every barrel sold to any country, anywhere in the world, denominated in American currency. Not pounds, not francs, not marks. Dollars. Part 2. Saudi Arabia will take its enormous oil profits and recycle them back into US Treasury bonds. The kingdom will become one of the largest financiers of the American government. Part 3. In return, the United States will guarantee the security of the Saudi regime. American military power, the most formidable force in human history, will stand between the House of Saud and anyone who threatens it. The Saudis looked at this arrangement and saw precisely what they needed. They agreed, and in that agreement, the modern financial world was born. What this deal created is difficult to overstate. Before the petrodollar system, oil-importing nations paid for their energy in whatever currency they suited them. After the deal, there was only one option. If Japan needed oil to power its manufacturing economy, it first needed dollars. If Germany needed oil to keep its factories running, it needed dollars. If any nation anywhere on Earth needed to keep its lights on and its trucks moving, it needed dollars first. This created something that no financial engineer had ever achieved with intention: permanent, structural, inescapable global demand for American currency baked into the very architecture of human civilization. Central banks around the world had to hold massive dollar reserves just to keep their economies functioning. Not because they trusted America, not because they admired American values, but because they needed oil, and oil cost dollars. There was no alternative. But the genius doesn't end there. The Saudis, now receiving payment exclusively in dollars, took those billions and sent them right back into US Treasury bonds. The more oil the world consumed, the more dollars flowed to Riyadh, and the more dollars flowed back to Washington. A closed loop, a self-reinforcing engine. The more it ran, the more powerful it became. The United States could run massive budget deficits, and the Saudis would help finance them. America could borrow at scales that would have triggered currency crises in any other country, and the world would keep buying the debt because the world needed dollars, because oil cost dollars. This is not a trade arrangement. This is empire, the most sophisticated empire ever constructed, not built on occupied lands or colonial administrations, built on a currency, built on a commodity, built on a deal made in a desert palace in 1974. The petrodollar system didn't just reshape geopolitics, it transformed Wall Street in ways that permanently altered American society. Saudi oil money flooded into American banks: Citibank, Chase Manhattan, Bank of America. These institutions suddenly found themselves awash with more capital than they had ever imagined. Billions arriving every month, needing to be deployed, invested, put to work. And they looked south. The entire developing world was hungry for capital, desperate to build roads and dams and factories and cities. And American banks, flush with petrodollars that demanded somewhere to go, were only too happy to oblige. Brazil borrowed tens of billions to build Brasilia, to develop the Amazon, to create an industrial base from scratch. Mexico borrowed against its own oil reserves, betting on a future of endless growth. Argentina, Chile, the Philippines, South Korea, all borrowed vast sums on terms that seemed almost impossibly favorable at the time. For a few brief years, everyone seemed to win. Skyscrapers rose in Sao Paulo, highways cut through the Mexican desert. Korea built shipyards and steel mills that would eventually compete with the world's best. It looked like the developing world was finally catching up, finally gaining access to the capital that had always been the exclusive privilege of wealthy nations. And then came the reckoning. August 1982, Mexico City. A young economist named Jesus Silva Herzog sits in a government office staring at spreadsheets that do not add up. They cannot add up, because the numbers describe an impossibility.